It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. I saw this article from an interview with Jerome Powell, chairman of the Federal Reserve, and I think this is something that most people missed, skipped over, whatever you may want to call it. But I found it quite interesting. First of all, the title of the article is Fed's Powell Defends Bond Purchases Amid Trump Allies' Attacks. The Trump administration has made no secret about their dislike of the Federal Reserve policies recently, particularly when it comes to interest rates. For example, Treasury Secretary Scott Bessent has stated the Fed policies have blurred the lines between monetary and fiscal policy. They believe that the Fed has overstepped their bounds, and their biggest issue recently has been the purchase of government treasury bonds. Now, part of the reason they're doing that is trying to prop up the market, the bond market, and keep interest rates somewhat down because the massive amount of bonds that the federal government is selling because of the massive level of debt. But they've also criticized the Fed's quantitative easing that extended far too long. And what that means is purchasing stocks and mortgage-backed securities to provide liquidity into the market, which caused historic inflation. And ironically, even Jerome Powell, chairman of the Fed, recently stated, with the clarity of hindsight, we could and perhaps should have stopped asset purchases sooner. You know, that's a really belated statement. If you had been listening to this radio show for quite some time, a good year or more before the Fed finally stopped purchasing assets, which was continuing to inflate the asset bubble, which inflated the stock market beyond its traditional valuations and the real estate markets, they were still buying assets, which was pushing prices up. Inflation was increasing, and they were still buying assets, which was completely illogical. It was foolish. It was very, very foolish monetary policy, and it doesn't require a PhD or someone with any intelligence, frankly, whatsoever to understand that. I still to this day don't understand why the Fed continued to purchase assets for as long as they did. It probably had to do more with political reality and the ease of easy money, low interest rate environment, made life simple for companies, easy. Everybody liked it, but it built up an asset bubble that, well, they're having some real difficulty trying to wrangle out of now. Caused this massive problem that we have yet to see the ramifications of. The AI bubble has now created even bigger asset valuations. And when the bubble bursts, and yes, I said when, not if, but when the bubble bursts, it's going to create some real, well, frankly, devastation financially for a lot of people. Now, what I can't tell you is when, how much, and how long. No one can do that. But you just have to look at history. And this was a great article from AI Magazine, in fact, why the Gen AI is hitting a disillusionment phase. I found this quite interesting. As they pointed out, the methodology, when it comes to tracking new technologies, it typically goes through 5 phases. There's the innovation trigger, the peak of inflated expectations, then there's the trough of disillusionment, there's a slope of enlightenment, and then plateau of productivity. And as this article pointed out, we are now at the point of peak of inflated expectations, starting to move into the trough of disillusionment. We had an innovation trigger. AI was a new technology, much like the internet was in 2000, computer technology prior to that. We've had other technological innovations that were transformative to the economy, like the automobile, the train. There's been others. And this cycle repeats itself, interestingly enough. That innovation trigger of the new technology and the promise of what it can do gets a lot of people excited. And then a lot of hype comes into play, and the expectations grow, and people raise money, and they make promises, sometimes far beyond what the realistic expectations could be. Eventually, you get a peak of inflated expectations, and then the third stage, the trough of disillusionment, comes around, because you start to realize that, well, the expectations and the hype may not come true or not come true in the time frame that the hype was projecting or what the investors thought. And you start realizing there's some challenges or delays or problems implementing this new technology. What I thought was very interesting is one of the top AI experts, he's from Tulane University, Shahua Sun, discussed that companies that replace workers with AI risk mediocrity. And the point he was making is companies that automatically cut jobs and replace them with AI tools are overlooking broader implications. As he points out, AI is a powerful tool, but its value depends on how it's integrated with human expertise. Sun points out the human side of work, tacit knowledge, context, and judgment, remains very difficult to replicate. Companies that view AI as a replacement for people risk mediocrity, while those that use it to empower talent are more likely to gain a sustainable advantage. He points out that generative AI does not automatically make people more creative, but it does boost creativity for employees who already have that inherently creative process. And over-automation takes away from what makes brands and companies distinct, and companies that rely too heavily on AI will likely find themselves looking generic, looking like everyone else. They'll fall into a gray area of rapid output, but no strategic thinking behind it. And work slop is one of those terms that's become common in the workplace. And that's because AI can produce faster outputs, but it can't replicate nuance or empathy or strategic thinking. That only comes from the human experience. And when AI puts out mediocre type of content, it does it much faster, so it creates more of it, which some studies have come out recently pointing out how many employees are now finding themselves using AI is not being a productivity helper. It's been a hindrance. It's actually taking them more time to clean up what AI created or clean up the slop, or the term work slop. Learning how to use AI and implement it is one challenge that it'll take human beings and companies time to figure out. And AI is going to have to improve in its capabilities. The other question, and I think it's the bigger one, the trillion-dollar question is this: how will we generate enough energy to power all of this AI? Turns out the U.S. Department of Energy states that U.S. data centers will use between 300 to almost 600 gigawatt of power by the year 2028. That's equivalent to the power used by about 40 million homes just for data centers. Now, the average nuclear reactor provides 8,000 gigawatts of power. So that means between now and 2028, just in the next 3 to 4 years, we would need to build over 70 nuclear power plants to generate that type of electricity. But that creates a big problem. The United States has only built 2 nuclear reactors since 1995, and it typically takes over 10 years to build one, start to finish. Nuclear power and generating additional electricity, we can certainly increase it, but I don't think it's realistic to expect the United States to ramp up 70 nuclear power plants, or the equivalent of that, in the next 3 or 4 years. Something is going to give. And this is why fund managers are now even stating that the AI stock boom is in a bubble. About 55% of fund managers polled by Bank of America stated that tech stocks are now overvalued, and they've soared amid a flurry of AI announcements. Now, if you're considering other alternatives, the fund managers also stated that over 60% of them believe that global equities as a whole are also too expensive. Recently, the International Monetary Fund and the Bank of England have joined the growing chorus warning of an AI bubble. The IMF and the Bank of England have both issued warnings. They state a sharp correction could occur if investor appetite for investor intelligence turns sour. The IMF chief was quoted stating, "Buckle up, uncertainty is the new normal and it's here to stay." The Bank of England stated that the risk of a sharp market correction has increased, and this happens to be the strongest warning to date about potential AI-driven market declines from the Bank of England. And the question isn't really, will AI be beneficial? But the question really is more like what we saw in the early 2000s with the dot-com bubble. The internet obviously became useful, but the amount of money being poured into the companies that sell this is out of proportion with the potential profits that these improvements might bring. And Barron's came out and stated, AI is not the dot-com bubble, but that won't stop it from ending badly. One of the key reasons that's come up recently why experts are worried about an AI bubble in the stock market. I think you'll find this very interesting because I have not seen this anywhere else. So I'm going to encourage you to stay tuned.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
Concerned about market risk? I'm Ferenc Toth, host of the Your Personal Bank Show. The S&P 500 valuations are higher than at any time ever recorded in stock market history. This includes 1929 and 1999. We all know what happened afterwards. It wasn't pretty. Elevated valuations increase risk to the downside. Annuities and Your Personal Bank offer unlimited upside with no downside market risk. Your principal is guaranteed. Contact Ferenc at yourpersonalbank.com to maximize returns, reduce market risk, increase liquidity, and reduce taxes.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. We're seeing a tidal wave of organizations, individuals, fund managers, banks, you name it, that are coming out and stating that they believe AI is now in a bubble. And one of the main reasons behind this, why experts are worried about an AI bubble, is one that I have not seen anywhere else. I've shared earlier a couple of the reasons. One is implementation has been more difficult or challenging than many might have thought, and probably is going to take longer for companies and individuals to really learn how to use AI, and for AI to get to the level where it's really beneficial, not creating more problems or work slop. It's a term we hear a lot. So being more beneficial than detrimental in terms of productivity. The other issue, of course, is where are we going to get the energy for all of this power needs that AI requires? Estimates are in the next 3 or 4 years that the United States would have to build the equivalent of about 70 nuclear reactors to generate the electricity needed for the estimated power needs. And the fact the U.S. has only built 2 nuclear reactors since 1995 makes that very daunting, to say the least. This electrical need, this level of power need, is coming up in the very near future, the next few years. You don't build nuclear power plants in 3 or 4 years. That's usually a decade process or longer, and there's no other electrical source that we're aware of at this point that can generate anywhere near those levels of power. It's equivalent of 40 million homes, folks. These are massive, massive numbers we're talking about. There's no other power source currently available that can do that. And even the tech companies are stating the same thing, that the only viable solution they see for power needs is nuclear. So it's going to be interesting to see how power generation can be ramped up in the grid. Unfortunately, in the short term, we're probably going to see increased electrical prices as demand rapidly increases with AI, which is not something the typical consumer is going to appreciate, especially given the fact over the last few years, inflation has wrecked a lot of homes and their budgets and increased costs of nearly everything out there. Increased electricity is not going to be welcome news. So there's going to be some pushback to that. The impossibility of creating that much more power to generate the power for all these data centers to run all this AI. But there's another reason that experts are becoming increasingly concerned about the AI bubble. And it has to do with return on investment. Or in other words, how much money is getting poured into these data centers to generate the computing power that AI needs, and when these companies will get a return on their investment or become profitable. Currently, according to the latest numbers published by OpenAI, they are generating about $1 of income for every $3 being spent. So they're losing $2 for every dollar they're earning. So when are they going to become profitable? Now, Sam Altman has estimated somewhere around 2029 is what he stated. That remains to be seen whether that'll occur. But here's another issue, and this is understanding the value of an asset, how long it's going to last and generate income to get a return on your investment. So recently, one of the hedge fund managers, Harris Kupperman, penned an essay, and he was discussing in this essay the absurd finances behind AI data centers. Kupperman's math found that the AI data centers have an impossibly short runway to achieve profitability. And here's the point. It turns out data center components age rapidly. They become obsolete through rapid advances in technology, or they break down over years of constant high-powered usage. Now, he published his findings in Morningstar, and it turns out he found out later that he had made a crucial mistake. He made a grim prediction that it was impossible for these companies that are rapidly building these data centers to obtain a profit from them because his estimate was that these data centers would last for about 10 years. So a company would build a data center, it'd be able to generate the computing power that would be needed for the AI for about a 10-year period, so it could make a profit, or it could make income, I should say, for about a 10-year period. Or what's known as a depreciation curve. You'd have an asset to generate income for about 10 years. And he assumed that it would take about 10 years before then requiring costly replacements. And based on that 10-year depreciation curve, his point in his article was, I don't see how there can ever be any return on investment given the current math. But he's now learned that the 10-year period was way too generous. It turns out, after talking to a number of experts in the industry, that physical data centers last for 3 to 10 years at most. He was using 10 years as the average. He also used a generous 25% gross profit margin. And it turns out that the profit margin is much less than that. Based on his overly generous projections, Kupperman assumed that the tech industry would have to generate $160 billion of revenue to break even on its data center spending just for 2025 alone. And currently, AI revenue is closer to $20 billion, so far, far less than 160. As he pointed out, in reality, the industry probably needs a revenue range that's closer to 300 to 480 billion range just to break even on the amount of money it spent alone just this year. This is for 2025 alone, and Kupperman pointed out, based on the data center builds that are on the books now for 2026, if you just add the 2 years together, he estimated that the tech industry would need approximately $1 trillion in revenue just to break even, and many trillions to earn an acceptable return on the amount of money it's spending. Kupperman's conclusion was, if the economics don't work, doing it at a massive scale doesn't make the economics work much better. It just takes an industry crisis and then becomes a national economic crisis. And one of the reasons why this is so concerning, that it's becoming, whatever happens in the AI space becomes the problem for the rest of the economy. Turns out, according to Harvard economist Jason Furman, he stated that AI investments for the first half of 2025 accounted for over 90% of U.S. GDP growth. Basically, the entire American economy has put all its eggs in one basket, the AI basket. And when that basket runs into challenges or problems or breaks, that could have a devastating impact on valuations. And due to the fact that there's an over-concentration in the AI space, in investments across the board, you take a typical S&P 500 index fund and upwards of 40% of it is based on the tech stock alone. This could have a devastating impact on millions of Americans' portfolios, retirement accounts, you name it. Now, the argument is, the bull's defense is, well, this time it's real, that there's a transformative revolution or the second coming, but which one is it? Is it a transformative revolution or the second coming of the dot-com crash? Personally, I think it's probably somewhere in the middle. You have arguments on both positions. You have reputable doomers and accelerationists debating about it pretty much every day. As I've pointed out, my personal opinion, based on history and seeing everything that's going on, I believe AI will have a transformative effect on the economy, much like the internet did in the early 2000s. But I also believe, because of the economies of scale, the amount of spending, the amount of money that's gone towards this, the amount of energy needs that are going to be required to make AI to be effectively make that difference, it's clearly going to take far more time than the investors who put money into this have believed, or the hype that was promoted for quite some time now. In other words, the markets and the valuations have got way out ahead over their skis on this, in my opinion. And there's going to be a sharp pullback or a sharp correction before things settle out, and then we actually start to see a real difference in the future. And I'm not the only one saying this. Mark Zuckerberg, Sam Altman, CEO of OpenAI, have both acknowledged that AI could be in a bubble. Sam Altman stated that the investment is out of control. Zuckerberg stated that current conditions remind him of periods of economic euphoria that ended in sharp corrections. So although Zuckerberg and Altman are not against AI, what they're trying to do is slow down the blind optimism surrounding the sector and remind everyone that even real technological revolutions often become inflated before they stabilize. And what we need to do is be very careful, proceed with caution. And that's what we're not seeing, is caution. And that's the point I'm trying to make here, is valuations have gone up so significantly, so quickly, and the promises and the hype have taken over any semblance of rational valuation. And the math doesn't math. It doesn't add up. The power requirements, the data centers' return on investment, their depreciation schedule being less than 10 years in most cases. These are things that are going to cause problems that are going to rear their ugly head in the near future. And there's an increasing chorus of very prominent people and institutions bringing this up. It will become to the point it will be impossible to ignore. And then the shift, the emotional shift, will change. Again, we're dealing with emotions here, not logic. Euphoria is an emotion, fear and greed. And emotions are a volatile and tricky thing. Most likely what we'll see is a lot of volatility. We'll see head fakes. We'll see all types of different things that will happen before we see a correction, which will probably then move back to some sort of reversion to mean and some semblance of rational thinking again. It'll occur, just a matter of time. No, I cannot tell you when. Week, month, year. Impossible to predict. How far, how long, who knows? We are dealing with, though, you need to understand, the largest bubble in the history of the stock market. 17 times larger than the dot-com bubble, 4 times larger than the mortgage crisis prior to the Great Recession. Professional investors scale out when risk is high. My suggestion, reduce your market risk. This is the golden age of fixed assets. We have products that will provide unlimited upside potential, so you don't have to give up the upside going forward with no downside risk. Downside is guaranteed, both with your personal bank policies and annuities. It's the best time in 40-plus years to look at these things at a time where risk is probably elevated to levels rarely seen in the markets. Consider pulling back, and there are even ways to reduce or eliminate the capital gains, which is often the concern people have. They say, well, if I do sell out of these highly appreciated assets, I've got to pay capital gains taxes. Well, there are ways to minimize that. Contact me at yourpersonalbank.com for more information. Stay tuned in the next segment, because I got a few more things to share about this that I believe you'll find very, very interesting.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
This is Ferenc, host of the Your Personal Bank Show. Your Personal Bank is a financial concept that allows you to grow your money insured with guarantees, income tax-free, and highly liquid. Also, you have the potential to continue to earn interest on money you invest in other assets, purchase items, or pay expenses. How can you do this? First, invest in a high cash value policy to earn dividends. If you leave money in the policy, it'll grow like any investment, insured with guarantees and tax-free. Second, we establish a bank line of credit using the cash in the policy as collateral. When you access funds, you receive them from the bank. Typically, dividends earned are higher than the interest charged by the bank. You keep the difference. This is known as positive arbitrage. If you want to earn interest on money you spent or invest elsewhere, contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So I've been sharing a number of reasons why many experts, prominent people, institutions are sharing that they believe we are now in an AI bubble. It's becoming a chorus. It's increasingly growing and growing. Jamie Dimon, CEO of JP Morgan, recently stated that AI sees stocks in some form of bubble territory. And he goes on and explains he worries about what is coming next. This chorus of concern by individuals like JP Morgan, Mark Zuckerberg, Bank of England, the IMF, you name it. We're even seeing folks, interestingly, even bringing up some of the echoes of the 1929 crash. Now, the reason why we're seeing some of these things is because the markets, from a valuation standpoint, PE ratios, or however you want to measure it, I really don't care, we're at or above levels ever seen in the history of the stock market. This includes 1929 and 1999, which were the two previous peaks. We are now above that. To put things in perspective, the AI bubble is currently 17 times larger than the dot-com bubble was at its peak. It's also 4 times larger than the mortgage crisis was before that then led into the Great Recession. But one of the things I find interesting, and it's Andrew Ross Sorkin, put out this article worrying about the similarities between Wall Street today and the 1929 pre-crash market. One of the points he brings out I think is quite interesting is this. I'm anxious that we are at prices that may not feel sustainable, and the market highs today have him feeling very nervous. He also goes on to say, I can't tell you when, and I can't tell you how deep, but I can assure you, unfortunately, and I wish I wasn't saying this, we will have a crash. Now, again, this is according to Andrew Ross Sorkin, who wrote a book titled 1929 Inside the Greatest Crash in Wall Street History and How It Shattered a Nation. He points out how the market of 1929 was fueled by rampant speculation, including by many ordinary investors unaware of the mounting risks. Sound familiar? Recently, we had some of the largest investments by retail investors in history. He goes on and points out people of modest means were lured by Wall Street bankers and other stock market touts to invest using what was then a newfangled concept called credit, called buying on margin. We are seeing historic levels of margin debt in the markets today. The other thing that we're seeing, I even had a recent conversation with a potential client who for the last 6 or 8 months has been day trading. I'm seeing this as a much more common thing recently than at any time I've seen since, 1999. And they seem to follow a common theme. She was purchasing options. It was working well for her for a few months. And then suddenly things changed, as she pointed out, in September, and she's been losing money since. And the group of people she works with are all having the same problem. And the comment she said to me is, it seems like Wall Street figured out what we were doing and pulled the rug out from under us. Now, without going into a lot of detail, I shared with her how market makers actually work. They see all the trades, buys and sells. I also pointed out that she's competing as a trader against some of the largest and most sophisticated companies in the world. You're trading against the Goldman Sachs and JP Morgan banks of the world. To beat that with all their knowledge, their capacity, the fact that they're right there in the midst of it is extraordinarily difficult. And I didn't want to burst her bubble or anything, but it is true that statistically is shown well over 97%, if not higher, of short-term traders do fail to make money over any extended period of time. And I pointed out to her also that I have some clients who were former traders on the floor of both the New York and Chicago exchanges and how they operate. I was also chairman of the bank of a FDIC-insured bank in formation, so I have some understanding far beyond most people in how this all really works behind the scenes. And there is a saying in Wall Street that many do not want to be repeated, but it's a fact that just like Wall Street and Vegas both say, if you play long enough, the house will win. I'm not saying it's a purely rigged game per se, but what I am saying is the cards are stacked against you significantly. And as I pointed out to her, again, not trying to burst people's bubbles, but I'm running into this more and more. There are a lot of outfits and people out there selling programs about how to day trade and trade options and short-term trading and things like that. And when you really look into their situations over periods of time, this is my 26th year in the business, folks. You know, I've been watching the markets and the economy and everything else daily. That's what I do for a living for 26 years. Personally, I wouldn't recommend trading short-term unless I was working for one of those major institutions on Wall Street. Or to be totally fair, if I was in Washington and had some inside knowledge, you know, like Nancy Pelosi, for example. And I genuinely mean that. They have an outside advantage against the average individual. And most of these organizations, and I'm not going to say any in particular, there's some that are better than others, but most of them make a good chunk, if not all of their money, selling their program versus actually trading. And if you think about it for a minute, it just makes logical sense. They sell the dream, don't get me wrong. People buy into the idea. They love the idea that, you know, they can get rich quick. Well, that's pretty rare in this world. And the few people I know that actually did get rich quick by selling an app or winning the lottery, I've got a few folks that I know that did that. And in most of those cases, frankly, 5 years later, financially, they were worse off than before they won the lottery or sold that app because they suddenly got a lot of money and really didn't have the financial discipline to understand how to handle it. So getting rich steady is actually wiser. But my point is quite simple. You have to think about this a minute and use a little bit of common sense and a little bit of logic that if somebody truly had a tremendous trading strategy out there that was successful and could make tremendous returns, why are they teaching other people and thereby creating too much attention to their trading system where then Wall Street, the market makers or whatever, can make changes to what they're doing or get wise to what they're doing, in essence, make their trading strategy not so viable anymore? Because they do. They change it up regularly. Again, I have former market makers as clients. I know this. See, if you really had a system that worked, you'd be using it. And you would be able to, say, gather money towards you being able to invest more of it, wouldn't you? I mean, I'm not saying nobody can make any money out there. But as I pointed out to this person, that it's very difficult to mislead me because when I deal with folks, I'm looking at financial statements and tax returns. I mean, those tell the true story, don't they? And by the way, in the real estate world, it's not uncommon to run in that same type of situation where there's a lot of folks out there that sell seminars or programs and books and tapes and whatever else they're selling, instead of actually going out there and just doing the real estate investing that they're supposedly teaching others. It's pretty rare that you run into somebody that's actually succeeded at, or continuing, I should say, succeed at it and teach it. It's a very rare commodity. I've brought John Burley on here several times on this show because he's one of those that I know for a fact who has done it for 30 plus years. I have a number of his folks he's worked with who are clients of mine. And again, I see financial statements and tax returns, so it's hard to lie to me. It's extraordinarily rare that I run into somebody who's done short-term trading for an extended period of time. I'm talking multiple years, and has been successful with it. Because the problem you run into, just like this gal had, is she had done some successful trades and had been making some money for a while, and then basically had one or two bad trades that, well, dissipated all the gains and lost more than she had made. So underwater. And that's the problem. You can make a lot of good decisions trading in the markets, and you can make some money you can make a lot of good decisions for a year or more even, and then suddenly have one or two bad decisions wipe all that out. A year's worth of effort gone. And what I found, this is just the advice from I used to teach a college-certified financial literacy course, and for most people, if you want to be successful, it's really not complicated to get wealthy in this country. Now, I didn't say it was easy, but it's not complicated. And what it is most people I know who have become successful, about 75% of them had some kind of business that they built, developed, and grew, and then maybe later sold it in retirement or kept going with it. But they did it over a period of time, typically decades. They found a need and filled it and learned how to be successful with it, and that was their economic engine. And about the other 25% are folks who typically in higher paid professions, doctors, lawyers, engineers, folks like that, with higher income, and then put a significant chunk of it away into, investments, retirement accounts, whatever, over a period of years, most typically decades, to build up a nice nest egg. That's how it's done. It's consistent, steady building wealth over a period of time. It's rare that the person ramps it up big time in just a matter of just even a few years. Again, I have a few clients, I've even interviewed a few of them on this radio show, who have built tremendous businesses. I know folks that have built businesses that are worth well over $100 million. They also, in most cases, have failed several times, been bankrupt several times before succeeding, and worked at it for years, if not decades. That's how wealth is built. So my recommendation from a financial literacy standpoint, and being in the financial world for 26 years and just being real, telling you about the real world, what it really is. For most people, your economic engine is your ability to make money. And that's not just me saying that. This comes from Warren Buffett. What is your economic engine? How can you make money? Is it a career that pays you well? Is it a business you can build that you can generate profits from? That's where you're going to build your wealth. And then, of course, live within your means, have some good financial principles. Don't overspend as you keep increasing income. Don't just blow it on nicer stuff. So if you kind of put the two together over time, if you are making more than you're spending, guess what? You're going to have some left over, aren't you? And then if you invest that over time into assets that we deal with, whether it's your personal bank or annuities with unlimited upside, no downside risk, or other types of things, over time, yes, you can build wealth. But again, it's the rare individual who builds wealth. They didn't build their wealth in the market. They became wealthy in the market after they had done something else to build up the nest egg. And then maybe they have done enough in there that they're now have a significant amount of assets in there. That's how it typically works. Now, if you're the exception to that rule, kudos to you. But please understand, you're probably in the 1 or 2%. I'm not saying this to disappoint anyone. But as I share with folks all the time, I'd rather tell you what you need to hear rather than what you want to hear, so that you can then truly become successful. And what you'll find also, as I'll share in the next segment, I got a few other things, is as you develop some wealth or as you get older, nearing retirement, it becomes more important not to lose than to gain. And that's going to be far more important as we continue through this AI bubble. When it bursts, a lot of people are going to learn that lesson the hard way, just like they did in 2008 or in 2000. Stay tuned in the next segment. I got a few more things to share with you that I, again, believe you'll find quite interesting, so don't miss it.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
Concerned about market risk? I'm Ferenc Toth, host of the Your Personal Bank Show. The S&P 500 valuations are higher than at any time ever recorded in stock market history. This includes 1929 and 1999. We all know what happened afterwards. It wasn't pretty. Elevated valuations increase risk to the downside. Annuities and Your Personal Bank offer unlimited upside with no downside market risk. Your principal is guaranteed. Contact Ferenc at yourpersonalbank.com to maximize returns, reduce market risk, increase liquidity, and reduce taxes.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So the first three segments, I discussed a lot of things about the markets, what's going on, the AI bubble, as more and more people are calling it. Well, let's assume for a minute you have benefited from this, whether proactively or passively. You have assets that increase in value, and you are concerned about future market risk, that we're in a bubble and we're going to have a correction, and maybe a quite severe one because of the extreme valuations. Well, what do? Number one, you want to reduce your market risk. You want to start to scale out. That's what the professionals do. That's what the institutional investors do. As risk accelerates, or I should say, as risk increases, they start pulling out. They typically don't go all in or all out. That's pretty rare unless we're at some extreme level, which could be said about the high end of the range we are now. But they typically start scaling out to reduce the overall market risk. Now, most people understand that, but then they say, well, gosh, if I sell this highly appreciated asset, we'll have capital gains taxes. Well, my first response to that is, don't consider taxes a bad thing on an asset that's appreciated in value, because for one, that means you're going to have taxes because you made money, right? I mean, that's better than the alternative. So don't always consider taxes as a negative. Now, are there ways to mitigate that tax, that capital gains tax gain? Of course there are. Now, one of the simplest ways, and we have numbers now, we've come out for 2026. By the way, you could still apply much of this in 2025. But for folks who have taxable income, if we look at someone who their gross income as an individual is around 65 grand or less because of standard deductions and etc., you can sell some assets with zero capital gains as long as you've owned them for a year or longer. For a couple, that number is about $130,000. Now, it can vary a little bit depending on deductions you may have or whatnot. If you're a couple with $130,000 or less in income gross for the year, you could be in a position, very likely, to be able to sell some highly appreciated capital gain assets that you have owned for a year or longer and sell them with a zero capital gains. And again, for a single, that's about $65,000. If you want more information on that, again, contact me at yourpersonalbank.com. But there's other ways of accomplishing this, depending on the assets, on what they're held, are they qualified or not, and counts and various things like that. If you're charitably inclined, there are charitable solutions, whether it's a various number of charitable trusts. There's other solutions that can be done, which you can create a guaranteed income for you, for example, and give you income tax deductions or capital gains deductions or reductions or deferrals. A lot of that depends on your income and your goals and what you want to accomplish. And the best thing, without getting into a whole lot of detail that could get really boring really fast for a lot of people, I'm just going to recommend, hey, if you're interested in that, you have assets with capital gains, you're concerned about the risk, you want to scale back on that, but you don't want to pay the capital gains or you want to minimize your taxable gains, contact me at yourpersonalbank.com. There's various tools and solutions to that I think you'll be quite surprised. One of the other things I want to discuss that is of concern beyond the markets themselves is the economy in general. And what's starting to happen is there's a bifurcation is really coming to bear more and more. And in fact, it's becoming a shocking disparity even between how high income and lower income earners feel about the economy. They're calling it like a K-shaped economy. The top income earners are feeling good about things and their assets are increasing in value, primarily because of the stock market and real estate markets to a lesser degree. And those that don't own a lot of stock, which happens to be a majority of Americans, they're not feeling so good about things. And a lot of them don't own homes either. So again, they're not participating in the benefits of the economy. So higher income consumers are far more likely to report stronger economic confidence readings, while lower income, say middle class and lower, confidence levels are quite a bit different. In fact, the top 1/3 of earners, their average consumer sentiment is 25% higher than the lowest third. That is a significant discrepancy, and this is something that is likely going to cause a lot of economic uncertainty. There's going to be political uncertainty, And if this type of disparity continues, it doesn't bode well for policy decisions, political actions, or the economy for that matter. And part of the reason why the lower half or so of income earners are feeling this way, they have valid reasons. For one, the percentage of subprime auto loans that are 60 days or more overdue has now hit an all-time high. This is the highest level of people behind on their subprime auto loans. These are people with not great credit, ever been recorded. Serious delinquencies, whether it be for credit cards that are 90-day plus, student loans, auto loans, any one of them, we're now seeing the highest levels ever recorded since the Great Recession. And the levels we're looking at are not much lower than the Great Recession and are on the rise. This does not bode well for the economy, partly because about 2/3 of our economy is consumer spending. And if you have the bottom 2/3 not doing well, consumer spending is going to slow down eventually at some point. So far, and I've shared this in previous shows, the top 10% of income earners are accounting for about half of all consumer spending. The economy is relying on a dwindling number of people to keep spending. That is not sustainable, not long term. And I've discussed this one before, but commercial-backed mortgages, oh my gosh, these are your, office buildings and things like that, are now, delinquencies are at the highest level ever reported, including the Great Recession, the financial crisis, all of that. The commercial space mortgage market is in a world of hurt. It's in the worst ever recorded, right? The Moody's article points out that roughly half of the U.S. states are effectively in a recession, and many others are hanging on by their fingertips regarding whether they're going to be in recession or not. It really truly is, as I shared earlier, Harvard study pointing out that nearly all of GDP growth for 2025 so far has come from the AI spending. There really isn't any growth to speak of anywhere else. Economically speaking, in terms of our growth, all our eggs are in one basket. Well, we all know that's not wise, or when you're investing, you don't want to put all your eggs in one basket. There's too much risk involved. What happens if that corrects? The results are going to be devastating economically. This MarketWatch article pointed out that if New York or California, for example, entered into recession, the entire U.S. economy likely would be next. And it's hard to say which one of those two might be the next one to go down. California, obviously, Silicon Valley is being driven by the AI boom. If that starts to slow down or correct, we're in recession. Or what about New York and Wall Street? Well, obviously, if the AI boom goes down, so will New York and Wall Street, won't it? They're all tied together. That's what I'm trying to say. The risk is elevated to levels we have rarely ever seen. Scaling out is what makes sense when risk is elevated. And if you can move into index products like index annuities or your personal bank policies with unlimited upside, with no downside risk, the principal is guaranteed, my gosh, why wouldn't you? And it's the best time in over 40 years for these golden era fixed assets. It's the best time we've ever seen for these kinds of products. And this is likely going to continue by most estimates for 5 to 10 years, if not longer. And another question I get asked quite often is this: when you do have a market correction, how long does it take to recover? Well, if you go back in history and look, the average ranges from about 5 to 15 years. Great example is in the dot-com bubble, the NASDAQ, which was the tech-heavy stocks, dropped 72% top to bottom, and it took 15 years to recover. The Great Recession, S&P dropped 55% top to bottom, and that one took 5.5 years to recover. So my point is quite simple. When I ask somebody, well, if you're invested in the market or you have significant amount of exposure to market risk to the downside, do you have 5 to 15 years to wait for it to come back to even or come back to where you were? Now, if the answer is yes, fine, stay there. Now, there's no reason why you have to stay there, and the professionals don't. Warren Buffett's not doing that. Again, when risk is elevated, they scale out. They don't pull it all out at once. They don't put it all in at once, typically. They scale a portion out, scale a portion out, scale a portion out. I get asked about precious metals all the time. I'll give you an example recently. I discussed RSI last week, which is Relative Strength Index. And you can apply this to any stock or anything that's invested. 50 is neutral in terms of pricing. When it gets up to 80, it's considered overbought or at extreme levels. And when it gets down to 20, it's oversold, so it's at really cheap levels. RSI on any type of stock or commodity or anything you want to measure rarely goes above 80. Silver recently, RSI has hit 80. And did you know that every single time since 1985, when RSI on silver, Relative Strength Index, hit 80, it was down after that for the entire next year. And the average, 31% drop. Will silver repeat itself again? Hard to say. But what's the trend show? What's the history show? The history shows that when a silver hits an RSI of 80, which it has, a year later, it's down 31%. By the way, every single case since 1981, not only is it down a year later, it's also down 6 months later, 3 months later, and even a month later. So when is silver going to correct? Historically speaking, probably pretty soon. And gold is not far behind, by the way, if you look at RSI. That's a good measure. I'm not saying make all your financial decisions or trading decisions or investment decisions strictly on Relative Strength Index. But that's one really good indicator of looking at history and looking at trends and looking at likelihood of what may happen and where risk is elevated, where you may want to scale out. So if you happen to own some silver, would it make some sense to scale out of it and sell part of it at this point, if not the majority of it? I would think so. And you could apply that to any stock, any position, any asset that you may own that's traded. So those are the kinds of things that, again, professionals do, institutional investors do. There's no reason to ride the roller coaster up and all the way back down and have to wait, on average, 5 to 15 years for it to come back to where it was, which means during that 5 to 15-year period, you made no money. And most of you are old enough to remember the first decade, 2000, after the dot-com bubble and burst, the lost decade. That's why they called it that, because if you were invested in 2000, it took about a decade for you to make your money back. If you're in the NASDAQ, it took you 15 years to get your money back, which means you made no money during that period of time. And that's what I would hate to see anyone who's listening to me right now suffer through that when you don't have to. Scale back, pull back some of your risk, put it into something insured, guaranteed, even tax-free, highly liquid, unlimited upside with no downside risk. Guarantee the downside. And depending on your situation and your income, capital gains that you may have had selling that position that had gone up, we can mitigate that. We can reduce it, in some cases eliminate it. If you want more information on that, contact me at yourpersonalbank.com. Encourage you to listen to the Your Personal Bank show next week for some more great information. And as long as it's on our money, in God we trust.
Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required.
This is Ferenc, host of the Your Personal Bank show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.